Howard Marks built a legendary financial career by being, the most patient man in the room.
Oh, absolutely.
He thinks in terms of business cycles. We're talking years, decades even. He's a guy who waits for the dust to settle before he speaks.
Right.
So when a mind that deliberate suddenly rips up his calendar to issue an emergency update just 11 weeks after his last one, will you stop what you're doing and listen?
It is a genuinely jarring signal.
Yeah.
I mean, in the landscape of high-level financial observation, patience isn't just a virtue, it's a structural requirement.
Yeah.
You wait for quarterly earnings, you observe the capital flows, and then you synthesize. When that rhythm is violently broken like this, it implies the underlying machinery of the world is moving faster than the financial models were even built to track.
Okay, let's unpack this, because that is exactly what brings us to today's deep dive. We are looking at a 46-minute audio release from February 26th, 2026.
Episode 76.
Right. Episode 76 of The Memo by Howard Marks, available globally on Apple Podcasts. It's titled AI Hurdles Ahead, and our mission here is to decode Marks' latest thesis and figure out what his framework means for you as you try to navigate the absolute wall of noise surrounding artificial intelligence.
And there's a lot of noise right now.
So much noise. But before we get to the tech itself, we have to talk about that timeline. 11 weeks. He published this just 11 weeks after his previous memo, and he explicitly cited massive changes in that tiny window. It's like updating a printed encyclopedia while the ink is still wet.
That's a great way to put it.
Mm.
And what's fascinating here is that in the traditional financial world, 11 weeks is effectively a rounding error.
Right.
It is less than a single fiscal quarter. Corporate strategy simply doesn't pivot in 11 weeks.
Yeah, that takes months or years.
Exactly.
Yeah.
So to step out and declare that the landscape has shifted massively in such a compressed time frame, it tells us that the metrics Marx traditionally relies on are lagging way too far behind the reality of the technology.
I hear that, but I have to play devil's advocate here for a second. Is it possible that even someone as disciplined as Howard Marks is just getting swept up in the frantic tech news cycle?
It's a fair question.
Because, you and I both know the echo chamber is deafening right now. Every single day, there's a new benchmark, a new model, a new headline screaming about how AI has revolutionized another industry.
Oh, yeah.
Are we actually seeing fundamental, massive changes in just 2.5 months? Or is the financial sector just doom scrolling like the rest of us?
Well, that is the exact trap we have to avoid falling into, and it takes a lot of intellectual honesty to separate the two.
Yeah.
It is incredibly easy to mistake a loud software update for a real paradigm shift.
Totally.
But if you look at Marx's rationale, he is looking at the actual essence of the technology's compounding capabilities, not the press releases. The speed of traditional commerce is linear.
Right. It takes time to build a factory.
Exactly. Or to launch a product line. But the speed of AI development is algorithmic. It's compounding. So what might look like daily noise to a retail observer is, to a rigorous analyst, a compounding curve that is steepening by the week.
Wow.
He's recognizing that the fundamental capacity of these models to process and generate information is iterating faster than standard quarterly financial reports can even measure.
So if the technology is compounding that aggressively, what exactly is the nature of the thing that is changing? I mean, he doesn't just wave his hands and say, oh, the tech is getting better.
No, not at all. He provides a very specific breakdown of its trait.
Right. He isolates its immense power, its speed, and this is the concept that really anchors the whole memo, it's autonomy.
Autonomy is the key word here.
But crucially, he locks those three traits directly alongside a heavy emphasis on its limitations.
Yeah, and if we connect this to the bigger picture, binding those concepts together is what prevents this memo from drifting into utopian science fiction.
Right, he keeps it grounded.
Exactly. He is grounding a profoundly capable technology in stark reality. Because autonomy is the dividing line between AI and historical software, but it is also the source of its greatest vulnerabilities.
Let's drill down into that autonomy, because the mental models we have for technology don't quite fit here.
How do you mean?
Well, think about traditional software or even the internet itself. I look at those like a massive, incredibly complex system of train tracks.
Okay, I like
You
that.
can build incredible routes, you can move massive amounts of data at light speed, but the train only goes where the human engineers laid the tracks.
Right, it requires explicit coded instructions for every single junction.
Exactly. What Marx is pointing out with AI's autonomy is that it's no longer a train on a track. It is an off-road vehicle mapping its own terrain in real time.
That's a huge distinction.
Yeah, it doesn't need tracks to navigate unstructured data, which is the source of its immense power. Previous innovations, like a calculator, they were like incredibly fast bicycles, but they still needed a human to pedal.
And AI's autonomy means the bicycle is starting to steer itself.
Exactly.
That off-road capability fundamentally changes the relationship between user and tool. I mean, historically, human beings have spent millennia mastering tools that amplify our efforts. But those tools were entirely passive.
Like a spreadsheet.
Right. A spreadsheet only calculates when you input the formula. A search engine only retrieves when you query it.
It waits for you.
Yes. But AI's autonomy means it is probabilistically generating its own connections, predicting logical steps, and synthesizing outputs without continuous human prompting.
It isn't just retrieving a file.
No, it is inferring intent and generating novel solutions.
Wait, if this thing is an autonomous off-road vehicle mapping its own logic, why does Marx spend so much time hammering on its limitations? I mean, if it's as powerful as he says, why is he so focused on the flaws?
Because the exact mathematical mechanism that gives it autonomy is the same mechanism that creates its limitation.
Wait, really? The same mechanism?
Yes. Large language models and generative networks operate probabilistically. They are basically predicting the most likely next step based on vast training data.
Okay.
When the data is high quality and the context is clear, that probabilistic generation looks like pure magic. I mean, it writes brilliant code or it drafts a flawless legal summary.
It's mind-blowing when it works.
But because it doesn't have true grounded comprehension of the physical world, it can just as confidently predict a logical step that is completely hallucinated.
So the autonomy and the limitation are born from the exact same architecture.
Exactly.
It's brilliant because it guesses, and it's brittle because it guesses.
Brittle. That is the perfect word for it, because a single logical error, compounding at the speed of an autonomous AI model, can wipe out massive amounts of value in seconds.
Oh, wow.
Think about it. If a human makes a mistake on a spreadsheet, it's localized.
Right, you just fix the cell.
Yeah. But if an autonomous agent acting on behalf of a financial institution hallucinates a market condition and executes trades based on it,
Oh, man. The fallout is instantaneous.
and catastrophic.
Yeah.
That brittleness is what is terrifying to a risk-averse investor like Marx.
So understanding AI, according to this framework, means holding those two opposing realities in your head at all times.
Exactly. It is a completely new breed of autonomous tool, but if you treat it as omnipotent, you will make catastrophic decisions.
But if you dismiss it because of its hallucinations, you will be run over by the massive changes it is driving.
Right, you have to thread that needle.
Here's where it gets really interesting. That tension between an autonomous force that is undeniably changing the world and a brittle tool prone to unprompted errors. It makes my head spin when we start talking about investing.
That's a lot to process.
Because if this technology is compounding at light speed but occasionally hallucinating, how do you even begin to assign a dollar value to the companies building it? It feels like trying to price a hurricane.
And this raises an important question, which brings us right to the core of Marx's warning. This is where the philosophy of the value investor meets the frenzy of the market. And it is perhaps the single most difficult cognitive leap for anyone observing a technological revolution.
Because his ultimate investment implication is very stark. On one hand, he expresses absolute, unwavering conviction that AI is far from a fad.
He plants his flag.
He does. It will transform the global economy. But on the exact same page, he issues a massive warning. He says investors must weigh that transformational potential against a strict, rigorous assessment of the appropriateness of the prices of AI assets.
It requires a fundamental rewiring of how you perceive value.
Yeah.
The determining factor of a successful investment is not the quality of the technology.
Yeah.
Let me reiterate that, because it is the anchor of the entire memo.
Go ahead.
A great technology does not automatically equal a great investment.
I hear you, but man, that's incredibly hard to swallow in practice.
Oh, definitely.
When you check your retirement portfolio and see AI stocks driving the numbers into the stratosphere, or you see a company releasing a model that does the work of 50 junior analysts in 3 seconds, the natural human instinct is to buy that stock immediately.
FOMO is real.
Exactly. You want to own a piece of the future. So how does a rational observer separate the reality that AI will change the world from the danger that the companies building it might be vastly overpriced?
You untangle it by looking at history, specifically at how markets price in expectations.
Okay, give me an example.
Think about the UK railway mania in the 1840s.
The railways.
Yeah, the railways completely revolutionized human transport, commerce, and communication. They were the AI of their day.
An undeniable world-altering technology.
Exactly. But the investors who bought into the hype lost absolutely everything.
Wait, really? Everything.
Yes. Why? Because the price they paid for the railway stocks assumed a flawless future. The prices assumed infinite demand, zero competition, and perfect execution.
Ah.
The technology succeeded wildly, but the investors went bankrupt because the capital expenditure was massive and competition drove margins into the floor.
And that is exactly what Marx is warning about today with AI.
Precisely.
So we are talking about valuation multiples. If a company is trading at, say, 50 or 100 times its projected future earnings because everyone assumes AI will give them a monopoly with zero marginal cost, that price tag requires perfection.
You hit the nail on the head. A sky-high multiple means all the future success is already priced into the stock today.
Right.
If an AI infrastructure company is priced perfectly, the market is assuming it will flawlessly realize its potential without any hiccups, without regulatory crackdowns, and without a cheaper open-source competitor undercutting them next week.
But we already established in the previous section that the technology is inherently brittle.
Exactly.
It has limitations, it will hallucinate, it will face massive compute costs, and there will obviously be regulatory roadblocks.
And if you paid a price that assumed perfection, you suffer the financial consequences of those inevitable bumps in the road, even if the AI technology ultimately succeeds in the long run. If you buy an asset with no margin of safety, you're taking on all the downside risk of the technology's brittleness while capping your upside because you already paid for the brilliance.
That is a staggering realization to sit with. The idea that you could be 100% correct about the future of the world.
Right.
You could be totally right that AI is not a fad, that it's an autonomous force that will transform every industry on Earth, and you could still lose your shirt because you didn't assess the appropriateness of the prices.
It highlights the extreme discipline required to navigate a period of rapid technological change.
Yeah.
You have to be visionary enough to recognize the immense power and speed of the innovation, but grounded enough to look at the valuation multiples and say, no, the math doesn't work at this price.
The technology is unprecedented, but the math isn't.
Right. The technology is entirely unprecedented. The rules of mathematics, cash flow, and valuation are not.
I want to push back on that last point, though.
Yeah.
Are the rules of valuation really immune to this?
Let's hear it.
Because software is not laying physical steel tracks like the railways did in the 1840s. The margins are different, the distribution is instantaneous, and the capital expenditure, while massive for compute, it scales globally in a way physical infrastructure never could.
That's true.
So isn't it possible that AI is so unprecedented that it actually justifies these historically insane multiples?
It is a fair counterargument,
Yeah.
and it is exactly the narrative driving the current market frenzy. The argument is that autonomous AI breaks the traditional economic constraints of labor and capital, therefore traditional multiples don't apply.
Right, the classic "this time is different" argument.
Yes, but Marx, as a seasoned distressed debt and value investor, has seen the "this time is different" movie play out across multiple decades and multiple asset classes.
Oh, for sure.
Whether it's the Nifty 50 in the 70s, the dot-com bubble in 2000, or the AI boom today, the underlying financial gravity remains.
Eventually, reality sets in.
The business eventually has to generate cash flow that justifies its enterprise value. AI might alter the speed at which a company reaches scale or the efficiency with which it operates, but it does not repeal the mathematical reality that paying $100 for $1 of future earnings is a highly precarious position.
Because if anything goes wrong,
If the growth decelerates even slightly, or the AI models become commoditized rather than proprietary, the multiple collapses and the investor gets crushed.
which perfectly frames the ultimate takeaway for everyone listening. So what does this all mean for you?
Right. Why does this matter today?
Why does a 46-minute audio release from February 2026 matter when you check your brokerage account tomorrow or when you sit in a strategy meeting at work?
It matters because you can adopt Marx's dual lens framework.
Exactly, to protect yourself from the hysteria.
The dual lens framework is essential for maintaining your equilibrium when the rest of the market is losing its collective mind.
Lens number 1. You must respect the immense autonomous power of AI. Acknowledge its compounding speed. Internalize the reality that we are dealing with a tool that steers itself, that infers logic, and that is absolutely not a passing fad.
If you ignore it, you will become obsolete.
But the second you acknowledge that power, you have to immediately look through lens number 2. Remain highly skeptical, highly disciplined, and completely unsentimental about the priced-in expectations the market is assigning to these AI assets.
Remember the inherent brittleness of the models.
Right.
Remember the massive compute costs and the open source competition.
Above all, remember that a world-altering technology does not automatically guarantee a profitable investment. Your job is to stay anchored to the fundamental appropriateness of the price, even when the technological leaps every 11 weeks tempt you to abandon your discipline.
It is brilliant, sobering advice from a guy who has survived every major market cycle of the last 50 years.
It really is. But as we wrap up this deep dive, I want to leave you, the listener, with a lingering thought to mull over on your own.
Ooh, all right.
We started this conversation by looking at Howard Marks, a man famous for his patience, being forced to rip up his timeline and issue an update just 11 weeks after his last one.
Yeah, breaking his own rules.
The speed of the technology broke his traditional calendar, and yet his core advice is to rely on traditional human-made metrics of financial valuation to diligently assess the appropriateness of prices.
Right, applying the old rules to the new tech.
But if artificial intelligence truly possesses the unprecedented autonomy and compounding speed that Marx describes, if it is fundamentally rewriting its own capabilities every few months, how long until those traditional human-made metrics for assessing prices stop working entirely?
That is a wild thought.
If AI continues to hurtle ahead, mapping its own logic and accelerating the global economy at a pace the human brain can easily track, will we eventually reach a point where autonomous AI disrupts and redefines the very concept of financial valuation itself?
I guess we'll have to wait and see.
It's definitely something to think about the next time you see a headline about an AI breakthrough, or the next time you look at the price tag of an AI asset. Thanks for joining us on this deep dive. Keep your eyes open and keep questioning those multiples.